All right, so Zest AI is helping lenders of all sizes take advantage of more data and better math to make better lending decisions. We're a company based in Los Angeles. Our clients range from the largest of financial institutions like the government-sponsored enterprise Freddie Mac, all the way down to regional specialty auto finance companies like Prestige. Um, we uh, we deliver software that helps manage the credit risk life cycle using AI to make more nuanced and clear decisions during the lending process, and help our lenders grow their business or reduce losses pretty substantially as a result of the use of this better data and more math. The automation that we're able to deliver helps lenders get through the underwriting process and the model development process, in particular, the development of custom scorecards and risk models 3 times faster than traditional methods. And with respect to COVID, there's just been a lot of changes that impact lending. The PPP program and small business lending, the underwriting process can rely on personal credit scores for risk assessment. Personal loans also tend to rely on credit scores. And in these times, credit scores aren't the full picture of someone's repayment risk or likelihood to pay back. Because now with the CARES Act, some negative indicators aren't being reported. And we know from 2008 that credit scores don't perform very well under stress. And so just to give an idea of what that means, in the lowest bands of FICO during the 2008 crisis, we saw a 45% swing in default rate. And in the highest bands of FICO, the lowest risk consumers, we saw 150% swing in terms of default rate. And so in times like these, relying solely on a credit score can cause you to mischaracterize the risk of an application when you're issuing a new credit card or a personal loan or a small business loan. Our tools help you monitor the character of the applicants that are applying, help monitor the scores that your models are generating. And what we saw in one of our customers it was a pretty counterintuitive trend. Their probability of default for new applicants was actually lower during the first stages of the COVID period. And we think this is sort of due after reviewing all of the application attributes and working with the team to do due diligence. We think this is due to the early applicants being more responsible and wanting to close any potential liquidity gaps by applying for a personal loan early on. And then later on in the crisis, we saw this risk profile tick up. So with the right tools, you can have visibility into how those applicants are changing, how the attributes are changing, and how the scores that you rely on to assess credit risk are changing over time. Here's another example of one of those tools. We were able to detect a 23% increase in multivariate anomalies. So this is a change in the character of the applicants that have started to apply right at the beginning of the COVID period, which allowed our lenders to really focus in on tightening up their underwriting standards, identifying those segments that were going to be higher risk than others. In portfolio review, many of our lenders are asking, well, what about the loans that I've already booked? I've already booked them and maybe they're going to go bad now at a higher rate. When you look at more data, things like checking account transactions, balance histories, deposit histories, and go beyond that traditional credit score, you can identify significantly more problematic loans with greater accuracy than ever before. And so in this case, for this 100,000 loan portfolio, we were able to identify 3 million more in high probability losses using machine learning and additional data. So most banks are still relying on the credit score to accomplish these these tasks. And we just like to see our folks, our customers, when they go beyond it, the great results that they can have. So how can Zest help in the times like these? We can help companies lend smarter so that every loan that they do make during this period counts. With defaults on the rise and charge-offs increasing, it's really important that the loans that you do make pay back and pay back profitably. And then second to origination and underwriting, we can help lenders protect their existing portfolios by understanding how that character of applications is changing, and also how the loans that they already have on the books are going to perform next month and the month after that. And so we're working with lenders of all sizes, community banks, credit unions, and national large financials to apply the tools of AI to make better decisions and to chart a course through this. And we're really happy to be here to tell you about it. So with that, I'll open up to questions.
Great, thank you so much, Jay. So we've got 2 questions from the audience. The first one is it possible to audit the underwriting decision made by Zest AI-driven models, or is it more of a black box?
That's a great question. AI has a bad rap. It's sort of gotten the reputation that you can't understand how decisions are made or how the models make a score. And that simply isn't the case. We have the tools to be able to inspect and understand how each and every model decision is being made and how the model makes its decisions overall, and even in specific segments. And so as folks are adjusting their credit policies during this time, it's tempting to do stuff like change, your policy to exclude folks that are in certain industries, for example, that are higher risk, like restaurants and entertainment. It's doing something like that comes with consequences. So you might be excluding, for example, more minority applicants, or as a result of choices like that. And so being able to scrutinize your model and understand how it's making decisions and what it's going to do in the world when you make changes is really important. And so we've been focused on that specific problem for AI models in lending for the last decade.
Okay, thank you so much. We just got a lot of other questions coming in, but I think we're running out of time. In our follow-up email, I think we'll cover some of those questions. Thank you everyone so much for submitting these. So thank you so much, Jay. We're gonna have to move on to the next presenter now.